A credit spread scanner promises to find you high-probability trades with a 70% chance of profit. It scans 500 stocks, filters by delta, IV, and liquidity, calculates the probability of profit using Black-Scholes, and serves up the 9 best trades. Sounds incredible. So I took its exact criteria and backtested them on 14 years of real options data, 5,830 trades across 5 stocks. The result? Bull put spreads made over $17,000 per contract. Bear call spreads lost $86,000. Same scanner, same rules, same stocks. $103,000 difference. And the reason why will change how you think about credit spreads forever. Here's exactly what I tested. I took the scanner's selection criteria. Short delta between 15 and 35%, 7 to 45 days to expiration, minimum credit of 10 cents, ROI between 5 and 50%, probability of profit, at least 60% from Black-Scholes, and spread widths of $1 to $10. I also applied the same liquidity filters, minimum bid of 30 cents and bid-ask spread under 10%. Every week, I picked the highest scoring spread, where the score is ROI times POP, and held it to expiration. I tested both bull put spreads and bear call spreads on SPY, QQQ, AAPL, NVDA, and TSLA. 14 years of real end-of-day options data. No cherry picking, no optimization, pure out-of-sample testing. Let's start with bull put spreads, which is the bullish side. You sell a put and buy a cheaper put below it. You profit if the stock stays above your short strike. And the results are impressive. NVDA made $13,451 per contract with a 79.4% win rate and a profit factor of 1.43. QQQ made $4,271 at 80.2% win rate. SPY made $4,055 at 79.2%. AAPL made $3,194 at 77.6%. The only loser was TSLA, which lost $7,228. And we'll talk about why in a minute. Look at SPY year by year. 13 out of 14 years were profitable. The only losing year was 2022, the bear market, where the win rate dropped to 59.6%. But even that was a relatively small loss. 2017 was the best year at 94.2% win rate. This is a remarkably consistent strategy. Now, bear call spreads. Same exact criteria, same scanner, same stocks, just the other direction. You sell a call and buy a more expensive call above it. You profit if the stock stays below your short strike. Every single stock lost money. SPY lost $9,163. QQQ lost $11,594. AAPL lost $18,484. NVDA lost $22,637. And TSLA lost $24,117. That's $86,000 in total losses per contract across all 5 stocks. The scanner said these trades had a 67 to 70% probability of profit. The actual win rates were 51 to 57%. The math said these should work. The market said no. This is the most important chart in the entire video. Look at the gap between predicted POP and actual win rate. For bull puts, the actual win rate was 10 to 16 percentage points higher than predicted. NVDA's POP said 63.5%. The actual win rate was 79.4%. That's a 15.9 percentage point gap in the positive direction. But for bear calls, the gap goes the other way. AAPL's POP predicted 67.9%. The actual win rate was 51.8%. That's 16.1 points in the wrong direction. The same model, The same math, completely opposite errors. Why? Because Black-Scholes assumes stocks move randomly with no directional bias. But stocks don't move randomly. Over time, the stock market goes up. That upward drift helps bull puts and hurts bear calls. The model doesn't account for this, and that one blind spot creates a $103,000 difference. NVDA was the standout performer, $13,451 per contract over 8 years. In 2016, it had a 100% win rate, not a single loss all year. In 2020, the AI boom drove $8,431 in profits. In 2023, the ChatGPT rally added another $6,314. The stock's massive uptrend meant that selling puts below the price was almost guaranteed to work. The PoP said 63.5%, but reality delivered 79.4%. That gap represents pure edge. TSLA was the exception. Even bull puts lost $7,228. Why? TSLA is too volatile. In 2022, it lost $10,184 in a single year. In 2018, another $4,499 loss. The problem is that when TSLA drops, it drops hard and fast, blowing right through your short strike. The higher premiums you collect don't offset the massive losses when you're wrong. TSLA also had the smallest PoP gap at only plus 5.3 points, meaning the bullish bias barely helped. If you're selling credit spreads, TSLA is the one stock to avoid. Here's what credit spread scanners don't tell you. They show you the PoP number and treat bull puts and bear calls as equivalent. A 70% PoP bull put and a 70% PoP bear call look identical on the screen. But over 14 years and 5,830 trades, one made $17,000 and the other lost $86,000. The scanner can't tell you this because it doesn't backtest. It just calculates a theoretical probability and assumes the model is correct. This is the fundamental problem with any scanner that relies on Black-Scholes. The model assumes no directional bias in the underlying, and that assumption is wrong. It's not a small error either. It's a 10 to 16 percentage point error that compounds over hundreds of trades into a six-figure difference. So here's the verdict. Credit spread scanners can work, but only if you use them for bull put spreads on stocks with strong upward trends. SPY, QQQ, AAPL, and NVDA all delivered consistent profits with 77 to 80% win rates and profit factors above 1.20. But the moment you flip to bear call spreads, the same scanner, the same criteria, the same stocks, it all falls apart. The 70% win rate claim is half true. It's real for bull puts. It's a lie for bear calls. Direction is everything. The stock market goes up over time, and that one fact makes all the difference between making $17,000 and losing $86,000. If you're using a credit spread scanner, my advice is simple. Only trade the bull put side. Avoid bear calls unless you have a specific reason to be bearish, and never trust PoP without backtesting the actual results. The model is wrong, and the error compounds. If you want to see more strategies put through the data grinder, subscribe and hit the bell. Drop your strategy in the comments and I'll backtest it. Data doesn't lie.